Money Miners, we've got a special episode today and it is brought to you by a special exploration drilling company, Swick, the underground. Leaders of the underground exploration drilling pack. We talked to 90 rigs, 17 million drill meters. Mate, tell you what, you don't become leader of the pack by following the pack, GC.
No, you do not.
Mate, every bloody one of those meters was done with innovation and grit.
Love it.
And determination. Mate, they can talk about going deeper. They can go bloody deep with the Deep X division.
Yes.
Drilling 2,000 plus metres with rigs built for reliability.
I love it.
Go Swick. Righto.
Thanks, Swick.
We were going to do a two-parter, but I've just made an executive decision. We are doing a one-parter, and it is about the life inside finance firm, inside a bank, inside the world of investment banking.
Bit of Finance 101.
Brought to you by the much experienced Ali GC. I want to hear about your life back in the day, what it's like doing capital raises, what it's like being in investment banking, how these capital raisings come about, who sets the price, what is a non-deal roadshow, what is wall crossing, why does a company choose this company to do the capital raising? Why do they want to do a capital raising so much? I want to know it all, GC.
Let's get into it, Matty.
I cannot wait for this. This is welcome to the autobiography of Ali GC.
Jesus.
Right, where should we start? Let's start with, the miner. It all starts with a miner. And they've got a project and it's going to cost them bloody $100 million to build this project.
Yep.
They come to Ali GC and her team and say, right, we don't know, we need $100 million somehow. We don't know, do we get $80 million worth of debt and try raise $20 million in the market? Should we just try raise $100 million? Like, what price do we raise this at? Like, how does this world work? Where does this process start? And do you all just get in a room and sort it out in a day? Take me through it, Ali GC.
It's an interesting one because, there's so many different, sort of funding or financing sources or mechanisms. And, depending on, your company, your project, the commodity, sometimes even the jurisdiction, it can affect how you kind of assess that funding mix. But I mean, ultimately, you want to sort of assess all these various factors across these sort of different financing mechanisms and go, okay, what combination of sort of pathways suits this project the best where the cost of funding is minimised? And by cost, I mean not just your financing costs, but, dilution, compulsory hedging, that sort of things. And it'll sort of, some way, flexibility as well. So,
and I assume that has the formula that is correct in 2021
might be very different.
For the exact same situation, could be different in today, 2025, with different commodity prices, different markets, different demand.
Oh, 100%. So, that's so commodity price, absolutely. But even, the markets for equity and debt, this year looked very, very different 4 years ago during, COVID times, right? And the appetite for funding via debt or via equity at different points in the cycle changes. So
and what do you mean by saying the appetite for equity? Please explain that.
People want to basically they're quite happy to give you money to fund your project because they think they'll get a good return on it. A financier.
So you're saying the appetite for equity means, say you're trading at $1, it means, and you need $200 million, and you say if it's within your placement capacity, or you do it in two tranches, and we can talk about two tranches.
We can.
As well. But say, right, we want to raise $200 million at 82 cents, so 18% discount. But you're saying that, 4 years ago, you couldn't have done that because no one would have given you the money. You wouldn't have been able to get the $200 million worth of shares, or it might have been at 70 cents or and when that doesn't work, you've got to go down the road of looking at things like debt.
Yeah, appetite's essentially another word for interest or demand, basically. So, for example, trying to do an equity raising for a nickel project this year, a very different situation than doing that, say, a few years ago.
And so how do you know if the appetite's not there? Is it like funds are saying, no, we are not paying that, or no, we are not interested?
Pretty
or
much.
We are really interested.
Yeah. So from talking to different financiers, different funds, they'll just say, yeah, look, because you show them different opportunities and things like that, and they go, yeah, cool, but no.
Yeah.
So it's, it's sentiment, but then, feedback from the sort of investing community and sort of financier community as well. The other thing that's can be is an important thing to think about when you sort of, okay, this is, there's a, say, let's call it for simplicity, a $100 million CapEx bill to bring this gold developer into production, but their market cap's $20 million. So, the CapEx requirement is 5 times that of their market cap. Now, it's challenging to do a lot of that via equity. When you're only 20 million market cap, it's pretty difficult just because of the, it's bloody that much bigger. So that might say, okay, well, maybe I can only do around this much equity. I'll have to look to other sources of financing like debt or royalties or streams or, something else to do the balance. You say that can sometimes be, it's not that it's impossible, but it can be a bit of a limiting factor.
So is it like if you're a 20 mil market cap and say, we want to raise $100 million via equity, we can raise $3 million within our 15% placement capacity, which is tranche 1, and then we want to raise $97 million in tranche 2, and there is enough people that want to invest at that price, at a certain price and a certain discount to put that money in. Can it be done?
Well, I think with placements, so second tranche, probably just to take a step back, what does that mean? It basically, companies have what's called placement capacity, where they can issue up to sort of 15% of their issued capital, sort of on a rolling 12 months basis, sort of as they please. They can get another 10%, which is called 7.1A under the listing rules.
And that has to be voted at the AGM?
You pretty much renew it every year. It's just like a standard. You'd see it in a lot of notices and meetings, renewing 7.1A capacity. Now, that not every company can get that. I think you have to be under a $300 million market cap company to have 7.1A from memory. So, yeah, that's the component. So what tranche 2, you often hear that tranche 2, what does that mean? It's basically the component of the placement which you can't do under your placement capacity. It's subject to shareholder approval.
And that's just a special, what is
it? At a general
meeting. So you'll say, is it EGM, extraordinary general meeting?
Pretty much just a general meeting, yeah.
And they can schedule that whenever they want to approve that tranche to
Yes, I think you got to give I think it's like about 6 weeks notice or something like that. But look, I think on paper, yes, you can do it, but it's just, it really depends on the project, the company, the deal, the interest. It's just not typically done that amount of equity for something that's for a company, say in this example, is like a 20 mil market cap.
Well, I think it's more saying if there was, it's never realistically going to happen, because if there was that many funds or investors that wanted to tip in $100 million worth into a $20 million company, if that interest was there, the share price would have been higher already because there would have been interest.
Yeah.
It usually just doesn't add up.
That's often a consideration. We're talking about more project financing here, but it may be in a situation where they're like doing a deal to acquire an asset, for example. That may be a situation where you sort of see that for sort of extraordinary capital raising size relative to a company's market cap. But in project financing, it's certainly not common.
So the latest example is probably, was it MI6?
So that was more of a deal. or an acquisition as opposed to project financing. But even say, okay, I'll have to look at some debt as part of my financing mix, say, if that's sort of appropriate, what's the appropriate, even debt, you can't just, not every project can just be 100% debt funded, because, what's the appropriate debt size for that project's cash flows that those project cash flows can sort of comfortably support. And, even that will have, a limit as well. And then there's also like, okay, would a sort of a traditional bank lend me this money, or will I have to look to something a little bit more, niche or obscure, which, they might charge more, a bigger margin, so a bit more financing costs.
Like getting a shitty home loan, a tier 2 lender.
Yeah, that's actually a great way to think about it. Or not necessarily, they're not necessarily shitty lenders. There's some that are, but they've got a bigger risk appetite than perhaps say like a CBA, for example.
So they up the interest rate to counteract the risk.
Yeah, and sometimes they're more, sort of specialists in natural resources. So because they can understand it at a simple level, have a better understanding. Maybe they've got a bigger technical team or things like that. They can understand the risk better and sort of take on a bit more risk. That's, just a general comment. Another thing is, is hedging mandatory, and that adds to your sort of considerations as well. Why
is it mandatory sometimes, GC?
Just pretty much to manage risk, really.
For the lender.
For the lender. Yeah, and because if okay, I've got a good chunk of my cash flows, I know I'm getting this price for, and, okay, say a portion that's at the spot level, which, might move up and down, left, right, whatever, it gives them a bit more confidence. Because, okay, well, if the spot price did this or if the spot price did that, because I've got that certainty for the hedging component as far as the pricing for that bit, can the cash flows are going okay? Are the cash flows enough to service the debt under sort of those scenarios? Yep, cool, great. It's just a bit more certainty and sort of manage the risk profile. But then in some instances, you've seen like, say in the gold scenario, right, where, some companies have survived just fine, but it's just more they've tapped out a bit of the upside in this sort of really rising gold price environment because they've had to put those hedges in place back in the day when they were getting project financing. So it's sort of a bit of a bummer now, but it is ultimately there just to sort of help minimise downside risk.
So when this process is happening, a company is come in for, could be a mix of corporate advisory, like the actual funding, the equity raise itself, and they come in and who's figuring out the strategy? What, do you all just get in a room and have a big meeting? Like, how long does this process take, and who's involved to determine we're going to be doing 70% equity and 30% debt, or we're going to be doing 70% debt, 30% equity? How does that work?
Well, it's just a combination of, you'd have like a team from the the corporate finance team at a bank. You'd have, the company side, you might have their sort of CEO, MD, CFO, that sort of thing. And you're basically trying to understand the project, its cash flows, what it can support as from a financing perspective, how, like all those various commodity, equity, debt, etc. financing markets, how are they looking at the minute? And it's a lot of sort of strategy and discussion and, financial modelling and things like that, and sort of scenario analysis. And then also, testing the appetite or the interest with prospective financiers as well. So it's just a bit of a feedback loop from all those sort of various items. It can take, it depends. It often can take quite a few months depending on the project and sort of what's going on at the minute and things like that. But it warrants that time. You want to get that as right and as best as you possibly can to get the right financing sort of package for a particular project that ideally is at not too costly either, can get that project into production as soon as possible.
Well, how do you determine if it is costly or not? Like when we hear everyone say, "Oh, their script's valued good at the moment," or it's cheaper for them to get equity than debt at the moment. Who determines that? What metrics are used? How do you say script's valued good? Is it a comparison to other stocks or historical performance, or how do they determine, we should raise money now instead of taking debt? We're better bang for buck on the dilution.
Look, it's a bit of both. You're looking at, your relative performance. You're looking at your own. Just talking as a company, you're looking at your absolute performance. What your stock might have doubled in price in the last 2 years. You're looking at what does cost mean. It's dilution. So, if you have to, the cash flows are the cash flows, but if you have to spread those cash flows over more and more and more shares, and, as far as a shareholder or earnings per share metric, it's going to go down. But then, if you're financing costs, if you're paying like a 20, equivalent of a 20 to 30%, financing cost, that's coming off your cash flow. So you might have the same number of shares, but if your cash flow number has come down a whole heap, your earnings per share might come off a whole heap too. So it's a few things. Yeah.
So when you're saying it, we'll get one piece of terminology out of the road before I ask about this sounding process.
Yeah.
Wall crossing, crossed. What does that mean?
Yeah. So wall crossing.
By the way, money miners, I do know the answers to some of these. It's just like the interview process.
Yeah.
I'm not a complete idiot.
It is all right. No, it's a good question. So you often hear this term, bringing someone over the Chinese wall. So
that's the other one. The Chinese.
Or wall crossing, you're crossing over the Chinese wall kind of thing. So the Chinese wall is essentially an information barrier between publicly available information and confidential material information that's not yet public. So in the finance world, in my experience, this is often done in like a capital raising sense, where you might wall cross potential investors in relation to a raise to test their appetite for the deal. So it's a very proper step-by-step documented process. Records are kept and, across the whole way. So you might ask a fund, we've got an opportunity I'd like to wall cross you on, is that okay? They might say, yes, okay, wall cross me. And they might
say... And you have to say it first.
You have to ask.
Yeah.
Because you can't force it on them. They might not want to be wall crossed. They'll say, no, speak to me when the deal's live. Or some of them will say, is it a stock that I own? And if it's no, they'll just say, yeah, I don't want to know, tell me when the deal's live. If it is a stock they own, sometimes, more often they'd like to know. Or some say like, oh, what commodity is it? This, okay, tell me or not. It could be a whole range of things, but it's, you're sort of seeking permission.
So that convo could go for bloody 10 minutes before anything's even, the stock's even
it's often pretty quick. Yeah. So if they tell you, yes, I'm happy to be wall crossed, you explain to them, XYZ company looking to raise this much to fund, development of this asset, looking to go live tomorrow or looking to go live in 2 days. This is what we're thinking the deal will look like, and terms and pricing, whatever. We'd like to ask for your, would you have any interest in sort of, participating in the deal, things like that, whatever. So, and the thing is, and the purpose of doing that is sort of to, like what they call, like in a raising sense, building like a soft book. So like, okay, sort of, in that perhaps 48 hours prior to launching a capital raising, go, okay, yep, I think we've got enough interest to cover what we're proposing to raise. Let's go ahead and launch, sort of thing. But the thing is, if you've once you're wall crossed, say I've shared this information with you about this raise, you say, oh, thanks, Sally. I think I might put $2 million in this deal, blah, blah, blah. You can't trade on that stock until that information that I've shared with you, so in this example, a raise, has become public, because otherwise it's insider trading.
But there's no form signed or anything, is there? It's a verbal exchange.
It's all documented.
Oh, so it is being wall crossed is documented.
Yeah.
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 Ah, right.
Yeah.
So when a broker rings up a fund and every phone call, the broker they will document that phone call to that person?
Yeah, you basically
potential investor.
You just keep notes, as discussed, wall crossed you on this opportunity at this time, blah, 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 blah.
Ah, righto. So it is yeah.
Yeah. So that's sort of that process, sort of, in high level nutshell.
Who gets priority? Like over, like say there's 10 funds wanting to tip in, like how much of it is relationship based and who gets a bigger allocation, or is it blended?
So this say in a capital raising sense?
Say there's a big equity raise, like Spartans, for instance. Spartan raised a big what they raised, a couple $100 million to, fund pre-production activities and things like that. How do the brokers that run these processes, the lead managers or the joint lead managers, determine the allocation of, okay, XYZ fund gets this much, ABC fund gets this much?
It's a very good question, and to be honest, in my experience, it's often a bit of an art rather than a science. Sort of taking it a step back, when a sort of capital raise is launched, it's, you hear this term, the book's open, or submit your bid before the book's closed. The book's basically, where it's something that the brokers or the lead managers submit their bids to participate in a capital raising. That's where they put their bids into the book. It's basically,
so they're not writing
not in a physical book. Maybe back in the day it may have been. That's where the term was coined. But investors, are saying, okay, this deal has gone live on, for example, Spartan raising this much money at this much price. I like to submit a bid to participate in that capital raising. The brokers collect those bids in the book. The book, closes at a certain time, and then the brokers then have to allocate the stock that's being offered as part of that raise to, the range of investors that have submitted bids. And often, you say, so if you're raising $150 million, if you're raising, say, $100 million, but you've received $150 million worth of bids, you've got to squeeze 150 into 100, and then that next step is what's called, we're going to cut the book. So make that 150 into 100. So to answer your first question, how do you decide, is it just everyone just gets a straight 2/3 of their allocation? Often that's not the case, especially in an institutional placement. It can honestly depend on a range of factors, but I had to go back into my memory bank a little bit. But a few factors, for example, are they an existing shareholder? It's pretty hard not to give an existing shareholder their pro rata, basically, if they own 10% of the stock, giving them an allocation where they can maintain their existing holding. It's pretty hard to argue against that. Did this investor who put this bid forward, did they cornerstone the raise? Did they provide really early interest and support to sort of, get the raise going and over the line? Is that investor a long-only fund where, could you see them buying on market post the raise, sort of to meet their ideal position size? Because the other thing, and that's where sort of, working with the stockbrokers in an investment bank, sort of have that, knowledge about funds. Because, for example, you might have a fund where they manage $100 million, and, they take 10 positions in that fund. So each position size is $10 million. Now, if you're giving them an allocation of, say, $7 million in this placement, that they're pretty likely going to have to chip away at $3 million worth of buying to get to that $10 million position size, which is, great aftermarket support. But, if you give them 1 million and then they've got to buy 9 million on market and perhaps that stock isn't super liquid, so that 9 million might take them 6 months to buy on market, they might go, oh, it's all too hard. I'm not going to bother. I'll just, I'll just offload the position or something like that. So even something like that's important to keep in mind.
What about if they've helped them out before? There was a previous raise where, like, they couldn't fill the book. They're like, look, can you help us out for another 3 million to fill the book
so
for
just
us?
a support. Yeah, so that could be an existing shareholder that's continued to be supportive. So
and the next round,
they're supportive again. The other thing as well, which you're often thinking perhaps a bit more in the early days before you get to the kind of equity raise for the development funding piece is, do these, say in a fund sense, do these funds have the capacity to write a bigger check? So for when we do get down the track project financing wise, could they write us a $10 to $20 million check for our $100 million development funding equity raise? Because that's important to keep in mind too, because you think, okay, whereas if it's a very small fund, they might participate in the raise, but it's not like you'd knock them back. It's more so when you're thinking about prioritising allocations, so that's another consideration, and there's plenty more. Those are a few that came to mind. So that's why it is very much a bit more of an art than a science. A lot of robust discussions and things like that.
And who is having those discussions? Is it the head of the corporate finance team? Like who has the final say on the bid? Is it it the MD or CEO of the actual company or the CFO? Who's got more play?
Yeah, no, that's a good question. So often, a broker will sort of work through that with their internal team. So like the corporate finance team, perhaps some of the senior stockbrokers in that team that have been collecting the bids in the book from these institutions sort of come to, okay, this is what we think internally is a good book for this project and what we're trying to fund and the rest of it. And then that's, presented to the company and that sort of recommended book. But ultimately it's, the company are receiving that money to fund their project or fund their exploration program or what have you. Ultimately they get to decide how they'd like it allocated. But the whole point of appointing a broker is to help with that process and get a recommendation and things like that. So, and look, there's often, it's not to say they're like, oh, look, I really like this book you've presented, but can we tweak this? Yep, okay. And then go from there. So, and often, it'd be, sort of senior executives from the company who do that. So like CEO, MD, support from the CFO, things like that.
What is the chairman's book? Is that what it's called? The chairman's book?
Yeah, so chairman's book or chairman's list. That's the term gets thrown around a bit. It's basically might be, some existing holders that the company would like to ensure that they have participation in the book, things like that.
So, and is that so? Say you're raising 1 million, is there potentially 200 grand allocated to the chairman's list that the company's board gets to decide exactly who gets that?
Oh, it's more of a that's what they'd like to do. Like we want, in your example, we want 200 grand to go to these 5 shareholders. We want them to get looked after as part of the raise, blah blah blah. That's can form part of the raise for sure.
I was on a chairman's list yesterday.
Oh, good on you.
I'm that type of guy.
Love it.
I'm just one of my existing holdings. But just, who wouldn't want me on the chairman's list?
What a good name to have on there.
Oh, just a ripping bloke. Look.
Yeah. Absolutely. But, look, like I said, it's, ultimately the company, it's they have the final say, and that's sort of, sort of one way they can do it. But I mean, really, they can just say, oh, look, we're happy with this, but, up, their allocation bit, pull that a little bit, try and balance it out. But that's one way. Probably that's more on I'd say on a smaller scale.
So the price, the capital raise price.
Yes.
Now, I've heard yarns about like whoever's tipping the most in the capital raise sets the price. But then I've heard stories about there's a company that could get a price with a very skinny discount. They could get it from multiple places, and this fund has gone to him, oh, no, where this is the price. He's like, no, I can get it at this amount, I can go elsewhere. He's like, oh, no, this isn't how this works. He's like, well, it is in this case. And there was this argy-bargy. And then the broker's like, oh, that's not really how this works. It's like, well, what do you mean? I don't understand. Like, I can get it at this price. I'm not going to get it at a lower price.
Yeah.
If I can get it at Y. And so they put their foot down. But how much of that is at play? Well, how does the price get set?
So there's a lot of different, I mean, you got to sort of figure out, how do you actually figure it out? So, there's it depends on, again, you're sort of looking at a small cap type raising to, more like an institutional placement style thing. There's a lot of different factors you got to look at. So, a simple one to start off with is like, okay, if I'm a copper developer, 100 million market cap, in the last few months, how much, and it's not like, say, the issue price itself, it's more so the discount to the last close, so the last price the company traded at, or the discount to VWAPs as a percentage. So VWAPs are volume-weighted average prices. So I'm going down a tangent here. So a VWAP, why not use an average price? Why use a volume-weighted? Well, for example, one day you could have 1,000 shares traded at $1, but then the next day you have 2 shares traded at $2. The average price would make it $1.50. But really, most of the trading happened at $1.
Yeah.
So that's why you use, okay, where's most of the trading occurring at? It's more down the dollar end. So that's why you often see in announcement things like discounts to VWAPs. So taking that back a step back, so you're sort of looking at, okay, well, all right, copper developers around my sort of market cap size, they're sort of raising, money at, sort of that 10 to 15% discount range. Okay, that sort of gives me a good like ballpark or starting point. But then, if that's a general rule of thumb. But then, if you're raising money because, you're in ramp up and you've run out of money and you need money to get through, that'll be, obviously at a much bigger discount to you. Say, in this example, 10 to 15%. Then it was, we made a great discovery 6 months ago and now we want to put 20-kilometre drill program through it. That'll be at a different discount to those sort of pricing points. So that's sort of a good general rule of thumb to sort of start off with. But then, what are the funds actually being raised for? That might, you might be a bit different to what the average copper developer might be doing in recent history.
So if stock's trading at $2, who decides whether it's going to be raised at, the funds are going to be raised at $1.85, $1.72 or $1.77? Who comes up with the number? Then,
so the other thing which sort of goes to answering your question a bit, so sometimes with larger raises where, you're reaching out, sort of on a confidential wall crossing basis, saying, hey, we want to raise, this is what we want to do, we're going to launch in a couple of days. What's your sort of level of interest in sort of pricing you'd look at? And they might say, you might say, we're thinking to price it at this. And they're like, okay, yeah, that's about right. Or they might go, no, we think this. And then other funds, you sort of getting a bit of a feedback loop as part of that process. And, ultimately the company can decide, what they want to raise it. But that sort of looking at precedents, what am I raising the money for? What's that sort of immediately before the raise that, soft book process, what's that feedback loop telling me? And then, as the broker, given sort of like a recommendation, we think something like this would work. It's a lot of things. It's a lot of things.
Yeah, okay. So, and could that, like, if you go too skinny, you could lose people that might have had interest at a lower price?
Yeah, because they go like, oh, no, that discount's too tight. No.
Because they want a bigger discount because they've got more chance of potentially then trimming a bit on the way out because it might trade higher, or they obviously just want better bang for buck.
Yeah, but I mean, the more you discount it, the more shares you got to issue and more dilution as well.
Yeah.
So it's trying to, that can be a bit of a factor too, dilution. But yeah, it's there's a lot of things you got to think about it. It's just trying to get that perfect, oh God, was it Goldilocks and the Three Bears? That like happy medium. It's a bit of hard work, but yeah, it's just trying to take into account all those various factors and find a bit of a happy medium. Really.
So what cases would you say like contribute to the most? Like a real skinny discount or a discount that is pretty close to the last traded price? Is it like commodity price? Is it
commodity price?
If MMS has been appointed as the open pit contractor?
That is often a big factor.
Yeah. So like that'd be like there's a chance you'll probably just raise at the last traded price.
Maybe a premium, I don't know.
Raise it a premium, like Develop did. Like remember, Bill raised it, I think, a 14% premium early on. Raised it like $3
Yeah, wow.
Because that's what he can do. Because he's got the name. That's what MMS can do. Like
now that they've got that technical services team as well.
Yeah, yeah. So you're saying if you want to avoid raising at a discount, potentially raise at a premium, look after the shareholders with minimal dilution, appoint MMS as your open pit contractor, have that as public knowledge, and it just makes
all good.
The book build is just like it'd be like a friggin' one of those Encyclopedia Britannicas. The book will be huge. Like it'd be
funds
thick.
from all over the world. I love it.
Oh, there you go. But there's the indirect benefits of having MMS on board for us, for your company.
Sorted.
Just like avoid shareholder dilution. Oh, good segue, Jeez.
That was a very good segue.
Now, what about one thing's the discount, but in the world of SPIVCos, options that get thrown in, like you'll get raised at a 25-30% discount, and you get a 1-for-2 attaching. Free
attaching option. Yeah, so that's another way which you can. It's sort of adding to the discount, but rather than doing it directly by the issue price, you've obviously got the shares that you're issuing at some sort of a discount, but then the free attaching option. If you valued that option, that sort of adds to the implied discount rate too. So you often see. At the smaller end of town, that can be included as part of the terms as well. 1-for-2 free attaching option at whatever exercise price.
Who determines the exercise price? It's all like is it always 50% above the placement price? Is it like what determines the exercise price of the options and the time frame on when the expiry date of those options?
It really depends, but it typically be a, 30, 40, 50 something % premium to the issue price, the capital raising price, or the last close. Normally with most options, I've seen they usually give them a sort of 2-3 years. It can be different. It really depends on the situation, but sort of the company and their broker sort of work together to sort of figure out what's suitable there. Yeah.
So take us into some real life examples based on your experience. Has there been ones where the soft book was filled and then you go to cut the book or finalise the book and the pages just start getting ripped out of the book and like the investors just go missing or something happens, like is it pretty regimented or can it really fall apart ever?
I mean, you can never say never, but typically the reason you do that is then so when the big day comes is it's usually not a problem. And one thing that can help intercept that is, so if you sort of broadly got your soft book, you're like, okay, we feel comfortable to formally launch this. The morning of, so very, very early in the morning, so before a trading halt's lodged to sort of formally commence the capital raising, you'd have what's called a go no go call between the company and the company's brokers to say, okay, gold, say if it's a gold company, gold hasn't dropped 50% overnight. No one's bombed anyone. No, there's no sort of big market shock or something horrible's happened that would, materially detriment our ability to go ahead with this. No, all good. Yep. Let's go. Then lodge the trading halt. Then off you go that morning. So that sort of helps, because there have been. It's rare, but there have been situations where it's like, someone's bombed someone and the market's been off overnight and stuff, and you might go, oh, okay, hold off for a moment, or things like that. But having that sort of step in the process can help that. But it's normally it's a bit like you do your homework before you sort of get started as well.
And it's done pretty quick. That's why it's like done within a couple of days. Like the go into trading halt, books built, and then like finalised, closed, then
So generally
start trading a couple of days later, usually, or 3 days later.
Yeah, so generally on ASX, you get a 2-day trading halt window to basically launch, complete the raise, allocate the stock, and then after those 2 days, announce, yep, we raised so much money. This is what it's going towards. Shares are settling in a week's time. So it's a very quick turnaround on ASX. Yeah.
Why does every broker want to do capital raises? Why is there the competition for capital raises?
The competition for capital raises?
Because they all want to be on the ticket.
But that's how they earn. I guess that's how they earn money, right?
Yes, so that's what I was getting to. Yeah.
Yeah.
So like, it's obviously some good coin in it for brokers to be running a capital raise process.
Yeah. Oh, I mean, you can. A fun fact. So when a company announces a capital raise, after they've announced that, they put out what's called an Appendix 3B. And part of that, it's detailed there, it's out in the world. You can see, if any, what fees have been paid to brokers to conduct this capital raising, and you have to, the company has to state that. Often you see sort of 5 and 6% running around. Sometimes really big ones will be, that percentage point will drop a bit.
So 5 and 6%. So you're saying if a company raises, a small company raises $2 million, they get 6% of that is 120 grand. So they get 120 grand just to run this, 2-3 day process and So they've done a lot of work in the lead up to secure that as well.
Yeah, and it's they're maintaining relationships with not just the company but the prospective investor pool and things like that. So and then that prep work. Obviously, there's a lot going on in that sort of few-day process, sort of putting it together. Yeah,
and a lot of mouths to feed as well.
Yeah. Investment banks aren't small these days.
Yeah. So how does this is just a full Ali GC show because I am interested. Can you pitch? You've now got a whole episode about yourself. You've got this Twitter profile. You've got this overarching. Everyone's looking at your investments.
So weird.
Welcome.
I don't understand
welcome it. To Into the Den, GC. So how does a company choose who is the lead manager, the joint lead manager, between all your Canaccord, Argonaut, Euros Hartleys, Shaw and Partners.
Yeah.
Bloody then, God, there's that many of them. Bloody Discovery Capital, CPS Capital, Evolution Capital, JP Equity. Bloody, who else have I?
You're listing the whole, but then you got all the big guys like, Macquarie and Barrenjoey and things like that as well. So, it's
But are they more on?
Do they do equity tickets as well?
Yeah, but not as they're more advisory than ECM deals.
They've got both. They do both, yeah.
Yeah, God,
but it's
who else is? I'm trying to think of every name. Cumulus Wealth. What was the other one? There is Sydney one. They'll be loving the free plugs here. These bloody, especially the small ones, they love this shit. I forget. There's.
I'll let it come to you. But yeah, I mean, there's.
They did the one for Mika recently.
I can't remember. But yeah, look, there's sort of different banks suit different sort of style and size, companies. You see those more bulge bracket banks, play at the bigger end. You won't. I don't think would have ever seen them playing in that sort of $5-10 million market cap end. You've got some. It's relationships. It's what else is there? If a particular, there'll often be people on the desk, part of the stockbroking team that may have been, following or supporting the stock over a period of time and introduced this, the story to the firm, and they can sort of see an opportunity like, okay, we can, we've got a client base we think would be interested in supporting your exploration efforts and things like that. Sometimes there's two lead managers that sort of fit that bill, and they work together to help, arrange an equity raising or things like that. It's very case by case, but those are some general ones that can often help.
Petra Capital.
Oh, Petra, yes.
That's it, bloody.
Yeah, over East, yeah.
Yes, God, thank God for that. Oh, because they would have been like, why have you mentioned up? But there's probably fucking missed heaps, but yeah. So what about the wheeling and dealing and the networking and the maintaining those relationships, and do the dinners with these companies, or the like hosting an event for these companies? Do they sort of, do the frequencies of that amplify when they might be perceived to be low on cash and maybe needing that?
It certainly
equity
tends to happen, yeah.
So they're in the front of their mind that this finance firm is like, oh, geez, we'll use them.
Yeah, that's certainly one way, or, taking them on sort of non-deal roadshows is one way. So you're sort of building that, relationship with the company and introducing them to, various, funds in the space that, like those sort of companies or stocks or projects and things like that. The research team might find an interest in that asset or company and go, we'd like to initiate coverage on it.
So is that
events,
is that what research
like that?
is for? Like research, because companies don't make money out of research.
Typically not.
But they do it for a presence to try and get in on the capital raise.
Well, technically research is independent. You can't technically. So, the research team that often, I wasn't part of a research team myself, but generally they'll have certain, criteria or, that they'd like to meet, to sort of warrant them going, this is something we think is worth, providing research coverage on, because that's time, that's resources and everything that they've got to commit to, to doing that. So it's a process, but, you can't sort of say, oh, you need to cover this. Like, it doesn't work like that.
So a non-deal roadshow, does the finance firm, what is the term? Like, what do you call it? Because they're not a bank, are they? The broker. Like, do you call them a broker?
It's sort of the term's sort of used interchangeably, but bank broker. It's
Bank broker, whatever. So if they're taking a company on a non-deal roadshow from taking them to Melbourne, Sydney, Brisbane to what is on a non-deal roadshow, and I assume the bank, the finance firm pays for everything. How does it work?
I'm not sure on your latter part, but the whole purpose of it's really to say, hey, we've just discovered this asset, or we've just bought this asset. We want to, sort of go around to the, certain members of the investing community, funds, the specialists in resources, or, stockbroking teams and things like that, to go, hey, this is our asset, this is what we're about, this is what we're doing. Just, awareness, basically. And sometimes, you can do as much as you like, sort of, in your ASX releases as far as investor presentations and more the kind of like digital or virtual type things. But sometimes doing that in person just works better. So that's why people, physically, they might fly over east or fly to North America, Europe to actually, look these people in the eye and talk to them about what they're doing and things like that. So
what
promotion, awareness.
Yeah.
Yeah.
So the broker, could be a broker and an analyst
might take them
with
around.
the MD, and they will sit
almost like chaperoning them around and, introducing them to various, funds and investors and things like that. And the company will tell their story and what they're doing with the project and things like that. So
will they sit in the meeting with them on the presentations?
Yeah, a lot of the time. Yeah.
So that's what a non-deal roadshow is. It's just a promotional thing. It's not. And what is it called? Non-deal roadshow. It's the same where there is not a deal happening to get excited about that's going to rise the share price. We're just spreading the company story.
Yeah.
But then why do a lot of deals and raisings or stuff happen after non-deal roadshows sometimes?
That's a question we'd all love to know the answer to, Matty.
Maybe they come up with the idea while they were having a meeting on the non-deal roadshow.
It very well could be the case.
Have you ever been on a non-deal roadshow, GC?
One or two, not a lot, no.
But you've organised a couple?
Sort of helped out here and there. Yeah.
What do you do? Book the meetings or?
They're pretty much administrative, really. But, reaching out, sort of thinking, I guess you've got to sort of put it from so if we're talking about funds, from their perspective, like, okay, what's their mandate? What sort of size company are they interested in? What sort of commodities are they interested in? What have they invested in recently? And that sort of can give you a bit of clues to sort of, okay, well, I think, they're worth asking, for a meeting or, worth an introduction, sort of based on all those sorts of things. I mean, it's just because they invested in this gold explorer doesn't mean they're going to like that gold explorer, but it just sort of gives you a bit of a starting point, sort of doing that research and that homework to go, okay, well, we think this is a, short list of people that are worth hitting and reaching out to, and based on the sort of those factors, and imagine many more that I just mentioned before, let's give them a crack and see what they have to say and see what they're about.
And they might start buying on market and drive the share price up.
Yeah, maybe
knows?
Maybe they love it that much. Who knows? But that's I think you've got to think about it from their process, because if it's a bit, you look a bit silly if it's like, oh, we don't touch base metals, but you're reaching out to us and you're a copper developer. Like, that's just you're wasting people's time there. So yeah.
So what about if a finance mob takes a company on a non-deal roadshow, then they raise, and I assume this has happened before, they launch a capital raising a month later, and the company that took them on the non-deal roadshow is not one of the lead managers or is not one of the companies on the ticket.
Yeah.
Have you seen that happen?
I probably have. I mean, it's unusual, but it's not just because, I guess, just because someone's taking you on a non-deal roadshow or say organised an investor dinner for you, something like that, you're not obligated to use them. But if someone's been consistently, like a bank or a broker's been very consistently supportive across a number of channels and different ways of the company and the project and all that. And then they didn't get on the ticket. I can understand why they might be frustrated, but yeah, just because you do that, it's not a guarantee. No.
Have you seen a physical outburst of someone that's a bit frustrated after something like that has happened?
Oh, there's a lot of colourful egos in banking. So
how did little bloody early 20s little Ali GC go in that alpha male environment?
Oh, you know what? Actually, I really enjoyed doing the equity deals because you sort of break out of the corporate finance bubble and you're getting to really work with the whole team across the firm. And I was like, I feel like I'm in a movie sometimes, like some of these characters and egos and things like that, which made it fun. But in my experience, I think I was pretty fortunate to be part of a culture where it's like, you know what, if you're smart, you work hard, everyone gets treated the same around here and gets the same opportunities, and my opinion and thoughts and ideas are respected. I'm like, you know what, that's for me, that's all I need is a good culture, because the rest comes after that.
So does my dress sense affect the culture around here? Like, is it a good culture here, GC?
It is, because you know what? I used to take so long to, this is a corporate thing, and you do the hair and the makeup and this and that. I'm like, I can just put on like a, quick bit of powder and some mascara and off. I'm like, it's actually just, I can sleep in a bit more these days, which is nice.
Happy to help you, mate. Happy to help.
And just, I think the people just, this is sort of any career really, but particularly in, sort of high pressure, high demanding areas like, finance and mining and stuff. If you've got good people around you that, you can have a laugh with, they sort of don't take you too seriously, but, when shit hits the fan and you got to hustle, that just absolutely makes it.
Sen, the last bit I want to touch on is we've talked about the relationship between the companies and the banks, finance for the brokers. What about the funds and the brokers? Because you've obviously got the broking arm of that business where the brokers are doing the trades. You got the insto desk, which is dealing with the funds. You've got the retail desk dealing with the bloody the Matty
sort of
Michaels of the world having a punt, and they're doing trades and everything. And I assume like the big funds have got multiple brokers that they could use.
Oh, of course,
but I assume there's a relationship as well between when there's a good deal, that when they're talking about allocation and everything, if you're not broking much through a company and you're doing shitloads of brokerage over here, they're not going to have you at the top of the line for a big allocation. Whereas if you broke with them all the time, does that happen on
yes and no,
figuring out who gets what in a capital raise?
Yes and no, because it's, ultimately, so capital raising, the client is the mining company that's approached you. So, what is having that particular fund good, on their register a good thing? Is it, if it is, then they should probably get a good allocation. That's from an internal perspective. Oh, they always broke it through so and so. No. But that's not really the point.
So I assume that's where the research gets used. Research comes important because you've got the research arm that is feeding the insto brokers.
Yeah, it gives them a good tool. Yeah,
and then that are then feeding information and trade ideas to the funds. And then obviously if the researchers have got good ideas and good trade ideas for the funds and the funds make money off it, then the funds will keep going through them. And then did you ever get a tag, GC?
No.
Oh, you bloody getting a tag.
I think it was too junior for a tag.
So a tag for people who don't know. So if a fund does a trade, they could send and they make money on it. They, at their discretion, they'll usually have a pool to distribute each year or between each person, each fund portfolio manager, and they'll just say, we're going to send old mate a $5,000 tag because they gave us this idea to buy this stock. But that doesn't go directly to that person. It goes to the bank,
the broking house,
house, and then they distribute it accordingly for the big end of year bonus. But it doesn't go directly to that person. No. It'd be good if it did. I swear I should be getting tags for all the shit I'm saying on the show.
Like, all your darts on the dartboard.
Oh yeah, bloody imagine the tag when they come off. Mate, that has been bloody. That's gone for an hour.
Oh like, shit! It actually has.
We were going to do a 2-parter, and a mining bit and a finance bit, but we've got an extra episode up our sleeve now.
We sure do. But yeah, no, because
that was bloody interesting. Well, a day in the life of a banker, broker. Yeah, so I assume, as you said, when you go into the raising side, I assume when you're in the banking bit and you decide, okay, we're going to raise capital to fund this, then you go sort of assist with the capital, the ECM side, the capital raise side.
Yeah, you've pretty much, in my experience, followed it the whole way through from sort of the inception to execution, which was really cool. Just being part of seeing it the whole way through. But yeah, so hopefully we sort of throw around sort of terms and concepts and make assumptions sometimes when we're on the show and talking through various deals and things like that. So hopefully the money miner's got something a bit more educational out of that and understand the sort of the finance side a little better. But I've certainly got some questions for Matthew as well, which we'll get into very soon.
We're going to, well, that might be tomorrow's ep. If there's another slow news day, here's the prelude. You want to know about jumbos and long holes, and I've got some videos to show of what this machinery does underground. But it's probably given me time to get more. But even I'm looking forward to discussing the, finance is one thing, like looking at all, bloody EV to EBITDA, PNAV and all multiples, these things, looking multiples of what things are trading that. And it's all based on sort of what has happened and it is based on predicted earnings. But I'm going to talk about the stuff you can look at in a mining operation to maybe give yourself a statistical chance to predict what's going to happen in the future.
Bit of like leading indicators.
Yeah. And it's all about rocks pretty much and the angles and shapes and sizes of rocks. So exciting times, GC.
I love it.
I cannot wait. Because I assume tonight at the dinner table with Stella GC, you are going to be on telly because we've just delivered the world the story of Ali GC.
Oh, I love it. No.
You tricked yourself into doing it. This was your idea too. And you tricked yourself into doing an autobiography.
It was to do a bit of both, but then it's all become a 1 hour special on finance.
I was so interested.
Love it.
And if I'm interested, hopefully other people are. Let's go run with that.
Yeah. But you know who else are pretty interesting, Matty, is MMS.
Oh, especially when they're helping you raise at a premium. Who else is interesting to you, GC, on the list? Oh, don't forget about the interesting AusIMM Underground Operators tickets that you can get $100 off.
MOM 100 discount code.
Link is in the show notes. Adelaide, April 7th to 9th. Cannot wait. Who else is interesting, GC?
We've got Grounded, Sandvik Ground Support, CRE Insurance, Cadril, Saltbush Contracting, SWIC, Quattro Project Engineering, and Cross Boundary Energy.
Hootaroo, money miners.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.